Ever wondered how to make better decisions in the stock market? Today, we're here to guide you through it. The stock market can be a gold mine or a minefield depending on how well you understand it. Informed decision-making is key. It's like being a detective, piecing together clues from the economy, market trends, and company performance. Uninformed decisions, on the other hand, can lead to substantial losses. Imagine walking into a maze blindfolded. That's what investing without understanding feels like. You might stumble upon the exit by sheer luck, but more often than not, you'll end up hitting dead ends. Now, you might feel overwhelmed at this point, but don't worry. The stock market, with all its complexity, can be understood and navigated. It's not about being a financial genius. It's about being informed, being patient, and making calculated decisions. Understanding the stock market isn't as daunting as it seems. Knowledge is power, and we're here to arm you with it. Before you can make informed decisions, you need to understand the basics of stock market analysis. This analysis is typically split into two categories: fundamental and technical. Fundamental analysis involves evaluating a company's financial health, looking at elements like earnings, revenue, and profit margins. It's about understanding the intrinsic value of the stock and making an investment decision based on whether it's under or overvalued. On the other hand, technical analysis is about studying market trends and patterns. It relies heavily on charts and statistical figures to predict future price movements. This type of analysis is particularly valuable for short-term trading strategies. So, whether you're considering a long-term investment based on a company's solid financials or playing the short game with technical analysis, understanding these two types of analysis is crucial. It's all about gathering as much information as possible to make well-informed decisions. Remember, a well-informed investor is a successful investor. Diversification, ever heard of it? It's a crucial part of any successful investment strategy. In the realm of investing, diversification is akin to an insurance policy against the unpredictability of the market. It's about spreading your investments across different assets to mitigate risk. Imagine this: you have a basket full of eggs and you're walking on a rocky path. If you put all your eggs in one basket, one unfortunate stumble could shatter them all. But if you put those eggs in several baskets, a stumble might crack a few, but not all. That's essentially the idea behind diversification. Having a balanced portfolio of stocks, bonds, real estate, or even commodities means you're not overly dependent on one particular asset. When one sector of the market takes a hit, another may rise, cushioning the blow. It's a way to navigate the ebbs and flows of the market, reducing potential losses while still positioning you for potential gains. Diversification isn't just about survival, it's about thriving in a volatile market. Patience isn't just a virtue, it's an investor's best friend. Now, why is that? It's because in the world of investing, long-term strategies often outperform short-term gains. This means resisting the urge to panic sell when the market experiences a downturn. Instead, consider investing as a marathon, not a sprint. One of the key concepts in investing is time in the market versus timing the market. Time in the market refers to the strategy of holding on to your investments for a long period, allowing your assets to grow over time. On the other hand, timing the market is the risky endeavor of trying to predict market movements to buy low and sell high. History has shown that it's nearly impossible to consistently time the market accurately. Instead, having patience and staying invested for the long haul have proven to be more effective strategies. Remember, Rome wasn't built in a day, and neither is a robust investment portfolio. Patience can often be the difference between success and failure in the stock market. Now that you have the tools, it's time to put them to use. Ready to make better decisions in the stock market? Let's recap. We've walked through the basics of stock market analysis, highlighting the importance of understanding the financial and competitive position of a company. We've also discussed the significance of diversification, a key strategy to manage risk and ensure a balanced portfolio. Patience, we've underscored, is not just a virtue, but a fundamental ingredient in the recipe for investing success. It's important to resist the temptation of short-term gains and focus on long-term growth. So, what's next? It's time to apply these principles to your own investing strategies. Remember, the learning doesn't stop here. The financial world is dynamic and continuously evolving. Stay curious, Stay informed. Remember, the journey to successful investing is a marathon, not a sprint. Stay informed, diversify, be patient, and you'll be on your way to mastering the stock market.